Imagine a world without capital markets. Where would businesses turn to for growth and expansion? Picture a bustling city, thriving industries, innovative enterprises, all fueled by the lifeblood of our economy, capital markets. These powerhouses act as financial conduits, connecting savers and investors with businesses in need of funding. They're the unsung heroes, the linchpins of economic growth and business expansion. So, what makes them tick? Capital markets are the invisible engines powering economic growth. Let's dive into their inner workings. Capital markets, a term you've heard, but what does it really mean? Let's break it down. Capital markets are financial markets where long-term debts or equity-backed securities are bought and sold. These markets serve two primary roles. First, they offer businesses and governments a way to raise capital for projects and services. Imagine a city needing funds to build a new bridge, or a startup looking for investments to grow. Capital markets provide a platform for these entities to connect with potential investors. Secondly, capital markets provide an avenue for investors, both individuals and institutions, to invest their excess capital. This could be anyone from a savvy retiree looking to grow his pension, to a large pension fund seeking to invest millions. In capital markets, these investors can purchase securities such as bonds and stocks, essentially lending their money in return for potential profits. So, to bring it all together, capital markets act as a bridge. They connect those who need capital to those who have it. They enable economic growth by facilitating the flow of money from those who have it to spare, to those who can put it to productive use. In essence, capital markets are the meeting grounds for those seeking capital and those with excess capital. Capital markets are not a monolith. They consist of two main components, the stock market and the bond market. To start, let's explore the stock market. This is where companies sell shares or pieces of ownership of the company to raise funds. Think of it as a marketplace where buyers and sellers trade stocks, which represent a claim on part of a company's assets and earnings. This is what we call equity finance. Companies use this method to generate cash, typically for expansion, research and development, or other large projects. So when you buy a stock, you're essentially buying a piece of that company, hoping the company will grow and increase the value of your investment. On the other side of the coin, we have the bond market. This is where entities like governments or corporations borrow money from investors. The borrower, or issuer, promises to pay back the loan by a specific date, and also agrees to pay interest on the borrowed amount. This is known as debt finance. Unlike the stock market, where you become a part owner of a company, the bond market is more like lending your money with the promise of getting it back, plus interest. The key difference between the stock and bond markets lies in the relationship between the investor and the entity needing funds. In the stock market, investors become part owners of the company, while in the bond market, they become creditors. These two markets, however, are not mutually exclusive. Many companies utilize both to balance their financial portfolio. They might issue bonds to finance steady long-term plans, while tapping into the stock market for more immediate, potentially higher-risk projects. So, whether it's a startup looking to launch their next big idea, or a government in need of infrastructure funding, the stock and bond markets provide the necessary platforms to raise capital. While the stock market and the bond market serve different needs, they both play crucial roles in capital markets. Beyond facilitating business growth, capital markets play a pivotal role in the overall economy. They serve as the backbone of the financial system and are integral to the functioning of a healthy economy. Let's dig into this a bit more. One of the primary roles of capital markets is the efficient allocation of resources. They channel savings and investments between suppliers of capital, such as savers and investors, and users of capital, like businesses, governments, and individuals. This promotes economic growth and development, ensuring that resources are allocated to their most productive uses. Capital markets also play an essential role in determining prices. They reflect the collective wisdom of all market participants, incorporating myriad information into the price of securities. This pricing mechanism helps businesses and investors make informed decisions, whether about investing, raising funds, or managing risks. Speaking of risks, capital markets are key in managing them. They provide a variety of financial instruments that enable businesses and investors to manage their financial risks. For instance, businesses can issue bonds to hedge against interest rate fluctuations, while investors can diversify their portfolios to spread and mitigate risks. Moreover, capital markets improve the liquidity of assets. They offer a platform for buyers and sellers to interact and transact, making it easier for investors to convert their investments into cash. This liquidity is vital for investors, as it provides them with the flexibility to enter or exit investments according to their financial goals or market conditions. Lastly, capital markets also contribute to job creation and innovation. By providing businesses with access to funds, they enable them to invest in new projects, expand operations, and create jobs. They also foster innovation by offering a platform for new companies, particularly tech startups, to raise funds and bring their innovative ideas to life. In essence, capital markets are economic barometers, reflecting and shaping the state of the economy. They are the conduits through which monetary policy impacts the broader economy, and their health and vibrancy are critical to economic stability and growth. As an investor, capital markets offer a plethora of opportunities but also pose significant risks. Navigating capital markets can seem like walking through a labyrinth, full of twists and turns. Yet, with the right tools and mindset, you can turn this maze into a treasure map. The key to this lies in three principles: research, diversification, and risk management. Let's start with research. Knowledge is your most powerful tool in the capital markets. It's essential to stay informed about market trends, economic indicators, and individual companies. This means not only understanding a company's financial health but also its industry position, business model, and potential growth drivers. Remember, the more information you have, the better decisions you can make. Next, we have diversification. It's a concept often preached but not always practiced. Diversification is the practice of spreading your investments across various assets or asset classes to reduce risk. Think of it as not putting all your eggs in one basket. If one sector of the market takes a hit, your other investments can potentially offset the loss. Lastly, we have risk management. Every investment carries some level of risk, and it's crucial to understand and manage this risk effectively. This could mean setting stop-loss orders to limit potential losses, or regularly rebalancing your portfolio to maintain your desired level of risk. It's all about striking a balance between potential returns and acceptable risk. It's important to note that while these principles can guide you, there's no foolproof formula for success in the capital markets. The markets can be unpredictable and influenced by myriad factors beyond our control. That's why it's crucial to stay flexible, adaptable, and resilient. Investing in capital markets can be rewarding, but it requires a strategic and informed approach. Capital markets may seem complex, but understanding their basic workings can open doors to numerous opportunities. Today, we've taken a deep dive into the world of capital markets, breaking down its intimidating facade into comprehensible pieces. We started by defining what capital markets are, these vast and intricate networks where buyers and sellers engage in the trade of financial securities. We then dissected the components of capital markets, distinguishing between the primary and secondary markets, and highlighting the key players, from investors to brokers. We explored the pivotal role that capital markets play in the economy, acting as conduits for wealth generation, economic growth, and fostering innovation. Navigating these markets as an investor, we discovered, requires a blend of knowledge, strategy, and sometimes just a dash of daring. We touched on the importance of understanding market trends, the need for diversification, and the value of patience and long-term thinking. This journey through capital markets has, hopefully, illuminated a path for you, whether you're an aspiring investor or a seasoned pro looking for a refresher. Your understanding of capital markets is your first step in the fascinating world of investing. In the end, the beauty of capital markets lies in their dynamism, their constant evolution, and the myriad opportunities they present. With this understanding of capital markets, you are now better equipped to explore the world of investing. Remember to like, share, and subscribe for more insightful videos on finance and investing.